Hey everyone, welcome. Today we're going to tackle something that drives so many traders crazy, timing your entry. I mean, if you constantly feel like you're one step behind, always chasing the market, then you are in exactly the right place. We're going to break down how to use the Exponential Moving Average, the EMA, to start anticipating the move instead of just reacting to it.
So let's just dive right into this, the trader's entry problem. It's that classic, super frustrating scenario, right? You see a stock or maybe a crypto asset, and it's just coiling up, building energy. And then, bam, it rockets higher. You hesitate for a second, you're waiting for that perfect confirmation. And by the time you finally jump in, the price is way up here, stretched thin.
So, tell me if this sounds familiar. You finally hit that buy button, feeling that FOMO, totally sure you've caught this massive trend, only to watch it immediately turn around and smash right through your stop loss. Look, if that's you, you are not alone. This is honestly one of the most common pains in all of trading.
You know, this quote just hits the nail on the head. Buying near the high of a thrust only to watch price pull back immediately. It perfectly captures that sinking feeling in your stomach. But what if I told you there was a tool literally designed to give you a head start? Well, the good news is there is. And its secret is all about speed.
And that solution is the Exponential Moving Average, or EMA. Now, you've probably heard of its cousin, the Simple Moving Average, but the EMA is, well, it's faster, it's more responsive. Its entire formula is specifically designed to react quickly, which makes it the absolute perfect tool for timing your entries.
So what's the actual difference here? While the Simple Moving Average, the SMA, it treats every single piece of price data the same. It doesn't matter if it happened 20 days ago or 20 seconds ago. So that old, kind of irrelevant data really slows it down. But the EMA, it's totally different. It puts a huge amount of weight on the most recent prices, which lets it react to new momentum way faster. And here's the simple little bit of math behind that speed. Now don't worry, you don't need to memorize the formula. The only thing you need to get is the idea of this smoothing multiplier. It's just a fancy term for the part of the formula that's designed to give way more importance to what's happening in the market right now. And just to show you how powerful this is, check this out. A 9-period EMA, which is a huge favorite for short-term traders, gives a full 20% of its entire value to the very last price candle. That is a massive emphasis on current momentum, and that's the secret sauce behind its super fast reaction time.
And this is such a great story. The legendary trader Marty Schwartz, he simplified his entire trading system down to a single EMA. He called it his red light, green light system. Super simple. If the price was above his EMA, it was a green light. He was only looking for buys. If it was below, it was a red light. It's just such a beautiful example of how one line can bring so much discipline to your trading. Okay, so the big question is, what's the best EMA? And the truth is, there isn't one. The right EMA for you is completely dependent on your trading style and your time frame. You know, using the wrong one is like trying to find a specific coffee shop in one city using a map of the entire country. It's just not going to work.
So have a look at this chart and see where you fit in. If you're a scalper, right, you're in and out of trades in minutes, grabbing tiny moves, you're going to want a super fast 9 EMA. But if you're a swing trader holding for days or weeks, you need something slower, like the 21 and 50 on a daily chart, to filter out all the noise and keep you focused on that bigger main trend. It's all about matching your tool to your specific job.
All right, now we get to the really good stuff, the actual strategy. Because the pros, they don't just use EMAs as a simple trend filter. No. They use them to execute one of the absolute highest probability entry setups there is, the pullback.
And listen, this right here, this is a total game changer for your mindset. Amateurs chase price as it's running away from them. But professionals, they identify the trend and then they just patiently wait. They wait for the price to pull back to a key level. In our case, an EMA. They let the opportunity come to them.
So here's a 4-step playbook. It's really simple. First, you use a slow EMA to confirm the main trend. Is it up or down? Second, you just wait. You let the price pull back to a faster EMA, which acts like a moving support level. Third, and this is so important, you watch for a specific price signal, a bullish candle pattern, like a hammer with a long tail, that tells you buyers are showing up right at that level. And finally, you pull the trigger, entering with a clear stop loss.
I love this analogy. It's just perfect. Think of the trend as this forward momentum, right? The price stretches away from the EMA like a rubber band, and that pullback, that's the moment it snaps back. A professional entry is timed to catch that exact snapback just before the next big move in the trend starts. Okay, so you see the pullback. It looks good, but how do you know it's a great setup and not a fake out? Well, pros use confirmation tools. They help filter out the weak setups so you can focus only on the trades with the highest chance of working out.
And here are two really powerful ones. First, look at volume. When you see a bounce off an EMA and you also see a big spike in volume, that's the big money. The institution's saying, yep, we're buying here. That's real conviction. Second, there's the ADX. All it does is tell you how strong the trend is. If you get a reading over 25, that suggests the trend is strong and worth trading. But if it's below 25, the market's probably choppy and directionless, and any EMA signal is way less reliable.
So I want to leave you with this one last thought. Ask yourself this: are you reacting to where the price has already been, or are you anticipating where you should enter next? That shift from chasing trades to executing high-probability entries, it's all about that one little distinction. The EMA gives you a clear level, a battleground to anticipate your entry, and that's what transforms you from a reactive chaser into a proactive trader. And that, right there, is the real secret.